Welcome back to our series on the U.S. consumer credit bubble, and in this part, we're going to be talking about the surge of consumer debt. In recent years, consumers have been taking on more debt in the form of mortgages, student loans, and credit card debt. And while some have been paying off this debt through savings and reduced spending, the overall trend is still rising and is concerning. One of the areas of concern certainly is credit card debt. Now, the surge of credit card debt has been linked to the surge in stimulus payments. Americans owed $887 billion of credit card debt in June 2022, and that's the largest increase in over 20 years. The average interest rate for a credit card is high, between 18 and 25%, even for people with good credit scores. And also what we're seeing out there is a rise in delinquencies, as researchers are stating that the delinquency rates are increasing to a more typical pre-pandemic level seen in 2019, which are still historically low. But they do want people to keep an eye on this trend, as if it raises above that level, it indicates much larger issues that are potentially on the horizon as household balance sheets continue to increase their amount of debt, and it could warrant concern for the future. The New York Fed researchers have observed an increase in delinquency rates among some borrowers, particularly in lower income areas. As supportive policies from the pandemic have come to an end, the trend appears to be resuming a pattern of rising delinquencies among subprime borrowers that was seen in 2019, particularly in auto loans, where subprime borrowers still represent a significant portion of outstanding balances. And the U.S. credit card debt has surged over the last year, with balances increasing to $100 million in 2022. The trend is most likely to continue and is indicative of an uneven economic recovery. Many Americans are concerned that losing their job would have a major impact on their ability to make credit card payments. Now, if we talk about delinquencies by age group, we can see that the delinquencies on consumer credit completely vary by the different groups, with younger borrowers having higher rates of delinquencies compared to older borrowers. This trend is seen all across different types of credit, such as credit cards, auto loans, and personal loans. Auto loans are typically on a risk-based pricing model, where borrowers with higher credit scores tend to have lower rates and more favorable terms. And lenders continue to be cautious with borrowers with lower credit scores and may even offer higher interest rates and requiring larger down payments, with younger borrowers being less likely to have established enough credit history and therefore may have difficulty obtaining the auto loans. Lenders may require co-signers or larger down payments for these younger borrowers. Conversely, older borrowers have even more established credit histories, may be able to qualify for auto loans with better terms. One of the things that we all struggled with after COVID was the impact of the 41% jump in used car prices and a 12% increase in new car prices. And now we're seeing those cars with their elevated prices come on the other end of the spectrum, where the delinquency rates are rising, with people in the South showing the highest level of delinquencies. Now, it's possible that subprime loans are what's contributing to these delinquencies and the rise in auto and student loans in 2022. They're offering loans to borrowers with poor credit, and they have a higher risk of default and delinquency. And what we're seeing out in the marketplace is that inflationary pressures are one of the driving factors pushing the prices up. So be sure to come back next week, where we're going to be working even deeper in the consumer credit bubble by really focusing on the auto finance industry. You don't want to miss this. Be sure to head to outlier.com, that's OVTLYR.com, to see how Outlier is turning investor behavior into stock market success.